Good evening, everyone, and thank you for joining us today. Welcome to the EY webcast, Decoding the New Income Tax Bill 2025. Our panel of seasoned tax experts will walk you through the provisions of the bill. During the session, please post your questions in Q&A box so that our speakers can address as time permit. I will now hand over the session to our moderator, our EY India National Tax Leader, Sameer Gupta. Over to you, Sameer. Thank you.
Thank you. Greetings, friends, and a very warm welcome to EY's special coverage on the new Income Tax Bill 2025 that was tabled yesterday by the Finance Minister. Joining me on the panel are my fellow partners. We have Pranav, who leads our transaction tax services, Vijay, who leads our transfer pricing services, Sonu, People Advisory Services leader, and we have Prashant Khator, who's a senior tax partner, and Ravi Kant, who's a knowledge and solutions partner. So with our panel, we will cover the provisions of the Income Tax Bill 2025. So let's get started. As we know, the tax certainty as well as ease of paying taxes have been continuing priorities of this government over the past few years. In keeping with those principles, the bill seeks to address the fundamental objectives around simplification of language, reducing litigation, reducing compliances, as well as weaning out or taking out redundant provisions. These are all objectives that were indicated by the Finance Minister in July 24. The Income Tax Act, which is the current 1961 Act, is very daunting to the best of the minds. And what the bill now proposes is a shorter piece of legislation where the flow of sections improvises its coherence as well as draws logical links. But to maintain stability in the structure, the current anatomy of 23 chapters and the heads of income continue. The bill, as we know, has been now moved by motion by the Finance Minister to be referred to the Parliamentary Committee. Along with the bill that was released publicly, additional material has also been introduced, which is very welcome. A lot of FAQs have been rolled out, more on the general purpose FAQs, as well as more specifically dealing with every chapter and every head of income. So with that, let me hand it over to Ravi Kant, my partner colleague, to talk through the design and the framework of the bill. Ravi, over to you.
Thank you, Sameer. Good afternoon to everyone. I can call this as a once in a generation change. We are seeing the change in the tax law. We'll go in the next 2-3 slides. We'll just cover and understand what is the broader design framework. What are the principles which went behind the drafting of the new bill. Now, first and foremost, what you have to understand and keep in mind is that it has been repeated quite often in the FAQs released by the CBDT, that there is no change in the tax policy or the tax rates. What this means is, like, say, for example, 72A, which is presently restricted to certain sectors, it remains the same. It is not open to other sectors. Or 80JJA limit, which is that whatever 25,000 per month salary, that is not increased. So those things remain the same. These are all matters of policy, which are addressed through the Annual Finance Acts. And the provisions of the latest Finance Bill 2025, they have already been incorporated in the new bill. Now, what Sameer referred earlier in the earlier slide about the 4 pillars. So, having read the fine print of the bill since it was tabled, our general observation is that most of the changes are in line with these 4 main pillars, which is simplification, reduction in litigation, or reducing compliance burden, or removing all old outdated redundant provisions. However, this is a humongous task. More than 60,000 man hours have been spent. 150 departmental officials have worked on it. And because of this change, it is very natural that sometimes certain drafting anomalies, unintentional changes do creep in. So most of the points that we will discuss in this webinar will be centered around that. However, there are also certain provisions there where there appears to be a conscious intention to reduce the litigation or to clarify a particular provision or provide clarity on a position of the department. Then the overall design and framework which guided the committee, I think we can divide it into two buckets which are there on the slide before you. Some points relating to design and structure and some points relating to the simplification. So majorly on the design, we have lesser number of sections on lesser number of word count. We will look at the statistics in the next slide. One unique thing is there are a lot of use of tables and formulas for many of the complicated provisions where you have to enumerate different things. So for example, TDS, TCS rates or the time limits, interest rate periods, etc. We have very well structured tables, user friendly, reader friendly tables, and even formulas are provided for ease of computation. Then there are certain provisions which are, which they are at multiple places, or a particular provision is very long, contains so many number of items, like section 10 contains more than 140 items. They have been moved to the schedules. And at some places, wherever the reference to the old act is necessary, say for example, for the continuing tax incentive holiday deductions, you have a definition of infrastructure facility. So that definition is there in the old act. It has not, and some of them may have a limited shelf life, or the tax holiday period may expire. So in those cases, the reference or the definition of the old act has been borrowed, which will continue, and in order to reduce the word count. On the simplification part, one of the major thing, and which I think everybody now knows about it, that the old concept of, well, we have been used to this concept of previous year and assessment year, that is being replaced with the tax year. It would be very interesting to know that this previous year and assessment year concept was brought in the 1922 Act for the first time, when 1922 Act replaced the 1918 Act. So after 103 years, we are moving back again to the same concept of an accounting year or financial year, what we conventionally understand, but legally now it will be tax year. Then there are reorganization of sections on similar topics. For example, certain the items relating to terminal payments of the salary, where they were in the exemption, it has been moved to the salary, so that a reader can easily understand, all the salary related things are at one place. One of the major thing is about charity, which I'll just come to in some time. Another very important feature is the conventional use of the provisos, explanations, which make the reading very unwieldy. Those have been removed. The data is the statistic data is provided in the next slide. And it is now long sentences have been reduced to short sentences to make it very easy to read and understand. There are certain phrases which have been conventionally used to, notwithstanding anything contained, so or in accordance with, etc. Those have been replaced with more common use, commonly understood phrases like irrespective of anything contained or as per, etc. Another feature is this simplified cross-referencing system, which was there in the Act. That the FAQ gives an example that if it is subclause 2 of clause B of subsection 1 of section 133, such a long provision would be there, which would be, we will get confused by reading it. We will not. That is now changed to what we normally use in our day-to-day language, in our advices, in our submissions, etc., which is like section 133, 1B2, like that. So it makes it very easy to understand, read, comply. The last important part is the transitional provisions, because we'll be moving from the old Act to the new Act. The returns would have been filed under the new Act. Assessment may have to be done in the new Act, like that. So for that, you have a transitional provisions, carry forward, mat credit, etc. For the transitioning them, we have the savings and the repeal clauses. We can move to the next slide, please. These are some statistics which are provided, word count reduced by more 50%, sections reduced to 536, 1200 and 900 provisos, explanations, etc. reduced, totally eliminated. Then if we have to navigate through the Act, I think, the flow remains the same as under the old Act, but there are certain changes. Otherwise, the flow, the normal flow that we are conventionally used to, definitions, then the substantive provisions, heads of income, assessment, etc., tax avoidance provisions, those all follow in the same sequence. But one thing I would call out is the provisions related to charities, which have all been, which was spread across 5 different chapters. They have all been put together in one chapter, which is chapter 17B, And the new name is also given. Instead of all charities, educational institutions, etc., we have now what is called as registered non-profit organizations. In fact, the changes, there may not be changes on the tax impact, but the way in which the computation, etc., will flow has been changed very drastically, for which possibly we may need a separate discussion in itself. We can move to the next slide. And the unique feature is about the schedules. Now, in the old act, there were 14 schedules. We have 16 schedules now under the new act. One may wonder why, but the main thing is this section 10, which I said contains more than 140 items that have been now spread across 6 schedules based on certain logical reasons, like one schedule related to dedicated to incomes, another dedicated to persons and incomes, another dedicated to non-residents, another dedicated to pass-through entities, and so on and so forth. One schedule deals with political parties, electoral trusts, etc. Now, Schedule 1, which is 9A, as we popularly understand, safe harbors for offshore investment fund, is also moved to the schedule. Then ATC, which we very popular, know so many number of investments, etc., that is also moved to Schedule 15. And lastly, the investments, etc., to be made by the charities, that is moved to Schedule 16. So I think that's about the overall design framework of the Act. Over to you, Sameer.
Yeah, so very quickly, Ravi, just one, you spoke about transitional provisions. So, if the bill gets enacted on April 1, 2026, do you expect any challenges due to the transition from assessment year to tax year in the first year?
No, I don't think so. Very curiously, when from 1918 to 1922 Act, we had moved. And that was the previous year that had become previous year assessment year. In fact, for 1 year, the income was being taxed twice. And therefore, they had to give a transitional relief sort of, and that's why that's the history behind the section 170. The person who discontinued the business or the successor was given a transitional relief. But I don't think that will happen, that the reverse has to happen now, that some year has to miss out on the taxation, but that will not happen. They have taken care draft in the savings and repeal clause that while you will file the return, while the income advance tax, etc., is paid for assessment year 26-27, the assessment may happen as a tax year 25-26. So I don't think there should be any challenge.
So that should be a smooth flow through. Okay, great. All right, thanks. Let's bring in Prashant to cover some of the key corporate tax related items.
Thank you, Sameer. Good afternoon, everyone. As you heard, the government has done a commendable job in simplifying the language of the law and arranging the provisions in a very logical format. But while you compare the new bill to the existing bill, you may find some difference in the fine print. And that's what we are going to bring forward to you. Some of these differences may be unintended and may get corrected because that's not in line with the intention, but some may be intendedly changed in order to bring simplicity. So let's look at the first one, the provision that currently helps in avoiding double taxation of intercorporate dividends in case of companies who have opted for a lower rate. You are familiar that under the current tax law, companies can opt for lower rate of tax of 22%. And also 15% if they have started a new manufacturing company. Now, if you have opted for the lower rate of tax, 22%, which is more prevailing, then you have to forego some of the exemptions and deductions. And in fact, now you can only get 2 deductions, which is one is for intercorporate dividend, which we popularly know as ATM, and the other is 80JJAA, which deals with hiring of new workmen. We'll talk about ATM. Under the current section ATM, if a company receives dividend from another company in a layered corporate structure, then the company receiving the dividend will not pay tax on such dividend provided it declares the dividend equivalent to the amount that it has received from another company. And that way the double taxation is avoided. Curiously, this section ATM is not replicated in the new bill for the companies which are opting for 22% rate, but this is replicated for new manufacturing companies which are opting for 15% rate. So this seems to be not in line with the intention and may get corrected when this gets passed. Let's look at the another provisions which deal with the taxability of the export benefit. You know that currently all the government incentives are taxable. And despite this taxability, Eastman Exports Tribunal judgment of Chennai Tribunal said that duty scrips received under market link focus product scheme is not taxable under the current law. Now, because of the wording under the new bill, which says that all export related incentives will become taxable, this judgment may no longer apply. And it seems that all export related incentives will become taxable under the new law. Let's look at another provision which deals with the subsidy or a incentive granted by the government in respect of any investment made. You are familiar that state governments provide incentives to promote investment in a particular state. Now, such incentives are also paid as a factor of investment that is being done. Now, under the current law, if such incentives are provided to reimburse the cost of the assets that have been put there, then such incentives are to be reduced from the cost of the asset for calculation of the depreciation. But the incentives that are provided as a lump sum, but as a factor of the amount that you have invested in the assets, on that the judicial opinion seems to be that this has not to be reduced from the cost of the asset. And if this is not to be reduced from the cost of the assets, then you have to offer it to tax fully as per the current law. Under the new provisions, a position is emerging that even if this is received as a percentage of the assets, you can reduce it from the cost of asset instead of offering it to tax. So this seems to be moving in a direction favorable to the taxpayer. Let's move forward. Now, under the domestic law, let's look at the rule which deals with taxability of royalty paid by one non-resident to the other non-resident. Under the current law, and let's take an example to understand this better. Under the current law, if a US company makes a payment of royalty to a German company, and the purpose of US company is to earn any income from any source in India, then such royalty paid by US company to German company becomes taxable. Now, in the new law, while drafting that, the effect of the change of the wordings is like this. If the US company makes payment to the German company for any royalty, and the purpose is to earn any income from any part of the world because of that royalty, then also it will be picked up for taxation in India, even though it has no connection with India. This seems to be purely drafting error, as it leads to extraterritorial income being brought to tax in India, which has no connection. So we may see the correction happening while this may pass. Let's look at the income attribution rules in case of a non-resident having a business connection in India. You know that the non-resident under the domestic law is taxable if it has a business connection in India. And in case of a business connection being there, then the income has to be attributed, and the law says that only the income which can be reasonably attributed to such business connection can be taxed in India. Now, this word reasonably has been removed. While we feel that removal of the word reasonable does not mean that tax authorities will get justified in becoming unreasonable on this, we still feel that tax authorities will operate within the 4 parameters of the law and do the retribution according to the 4 parameters in the law. So not much of a change, but curious to see why this change has been done. Let's move forward. Let's look at the interpretation rules for the terms which are used in the tax treaty. Now, currently, the law does not give any guidance on if there is a term which is used in the tax treaty, but it has not been defined in the tax treaty, nor it has been defined in the income tax law, nor there is any notification which explains the meaning of that term. Then current law is silent on how to interpret that. The new law enacts something which is novel. It says that if such term has to be interpreted, it has to be interpreted according to the meaning assigned in any other central government law which deals with taxes. And you can also refer to any other central government law which is a non-tax law. So this is something which is a new provision. Let's look at how it emerges. You know that the government, in order to avoid the dispute regarding the profitability, has provided for presumptive taxation regime for various non-resident businesses. But if the non-resident feels that this presumptive taxation regime is leading higher taxation to them, then they can opt out of it by maintaining the books of account and getting that audited and claim a lower rate of taxation. Now, this presumptive taxation regime opting out is not available in all the situations. So what they have done is they have offered this benefit to some of the businesses like shipping, operation of aircraft, or cruise, which was not there earlier. But curiously, they have not extended this benefit to the newly enacted presumptive tax regime, which dealt with the provision of services and technology for operation of the electronic manufacturing facilities set up under the ministry scheme. Let's see how it develops. Over to you, Sameer.
Thanks, Prashant. Thanks for identifying some very interesting situations. So let's see which get clarified and which remain over time. So very quickly on the financial services or funds related aspects, again, the IFSC related provisions are across a bunch of sections, and they have now consolidated all of these and moved them into a single schedule. On FPIs, there is no change. They've only brought about it in a user-friendly manner where all the tax rates are now in a tabular format. And from a pass-through entity perspective, whether it is securitization trusts, whether it is business trusts or investment trusts, VCFs, all of these remain unaltered. One item which does require to be clarified, this is in the context of 9A, which is offshore fund onshore manager. Currently under the current Income Tax Act, there is a provision whereby the central government can modify any of the conditions that have been specified for this section to apply for a fund to basically say that central government can make a change to the conditions if the fund is managed by an IFSC fund manager. The Finance Bill 2025 has separately proposed to take away this power only with respect to the condition which relates to direct or indirect participation not exceeding 5% by resident Indians. So this is where we are as of the position today. As far as the bill is concerned, the bill has brought the same condition in two parts. One, the current law is reproduced in the main section, whereas the schedule that I spoke about contains the proposal which is there in the Finance Bill 2025. So obviously only one of these will survive, and we will need to see how that gets rationalized. So that's the anomaly that is there in the bill as it has been presented as of yesterday. With that, let me ask Pranav to come in to speak through the capital gains related changes.
Thank you. Thanks so much, Sameer. Thanks, Ravikant and Prashant as well. Good afternoon, everyone. So one of the changes that we see in this particular bill relative to the 1961 Act concerns the definition of demerger, which, as we know, if there is a qualifying demerger under the provisions of the Income Tax Act, is something which would entitle the demerged company, the shareholders of the demerged company, and the resulting company to get complete tax neutrality for all practical purposes under the income tax law. Currently, Section 219AA, as you know, of the Income Tax Act defines a demerger and stipulates various conditions before a demerger is regarded as one which qualifies for the benefits of this tax neutrality. One of the requirements is that all the assets and liabilities of the demerged company or the undertaking which is proposed to be transferred is transferred at book values from the demerged company to the resulting company. So the undertaking that is demerged, all its assets and liabilities must move at book values from the demerged to the resulting company. While when the provision was originally introduced, it would work absolutely fine, because at that time we had accounting standards, and particularly accounting standard 14 applicable to amalgamations used to be applied to demergers. And there was a pooling of interest method. Practically, these assets and liabilities moved and were recorded at book values. With the introduction of Ind AS, what happens is at times the books of accounts of the demerged and resulting company, if Ind AS applies, do record these at values as required under the Ind AS provisions, with the result that a proviso was introduced in 219AA3 to provide that so long as the resulting company is accounting for these as per Ind AS, the need to account for it at book values, the condition will be regarded as relaxed. However, it spoke nothing about the demerged company and whether it will also be entitled to a relaxation from the mandate to record the transfer of assets and liabilities at book values. Fortunately, it seems unintentionally though, because all provisos have gone and this proviso also has been removed, and the relevant part of the proviso has been introduced as part and parcel of section 235C of the bill. What is happening is that so long as Ind AS is followed, both the resulting as well as the demerged companies could record these transfer of assets and liabilities of the company as per Ind AS, notwithstanding what the book values might be. Certainly, whatever little ambiguity did survive after introduction of Ind AS now should get eliminated thanks to this particular new bill. Moving on further, when it comes to liquidation, we know that currently the provisions of the law clearly stipulate that the company going into liquidation is not taxable under the head capital gains. However, the shareholders of a liquidating company are taxable under the head capital gains. The respective provisions are 46(1) and 46(2). However, when it comes to defining short-term capital assets for determining long-term or short-term capital gain, the definition of short-term capital asset clearly provided that in the case of a share held in a company in liquidation, there shall be excluded the period subsequent to the date on which the company goes into liquidation. In short, if a shareholder of a liquidating company holds shares for a certain period of time prior to the company commencing its liquidation, up to that date would be regarded as his period of holding for computing short-term or long-term. And the period after the date on which the company goes into liquidation was to be excluded for determining the period of holding of the shares. The new bill more or less seems to continue with that principle. However, the red portion does not find place in the new bill, meaning thereby that the new bill says that in such a case where there is a liquidation, there shall be excluded the period subsequent to the date on which the company goes into liquidation. It does not specify that this particular exclusion for determining short-term versus long-term is in respect of which capital asset and which taxpayer. The current law is very clear, as the red portion indicates. It applies to the shareholder in respect of the capital asset, namely share of the liquidating company. The new bill seems to be completely silent on this, thus leading to an ambiguity as to whether it applies only to the shares of the liquidating company in the hands of the shareholder, or does it also apply to the assets in the hands of the liquidating company, if they were to be sold prior, not distributed to the shareholders, but sold prior to the final liquidation completion for determining short-term or long-term capital gain. It seems that the intent was to apply this as under the current law also only to shares held in a company in liquidation, which we hope would get clarified by the time the bill becomes law. Moving on further, we know well that in the case of an indirect transfer, thanks to the Vodafone tax that was introduced, thanks to that tax, any indirect transfer of a share or interest in a company or entity registered outside India could also become taxable in India if that particular overseas entity or company derives substantial value from assets located in India. Under the existing provisions of explanation 911, explanation 5 to section 911, it is stipulated that this applies in the case of a capital asset being any share or interest in a company or entity outside India. Now this leads to some ambiguity as to whether share or interest in a company or entity outside India was meant to be interpreted as share in a company, interest in an entity, maybe a partnership firm or an LLP, for example, outside India. And there was some debate as to whether, therefore, the share applies in the context of a company, whereas the term interest is qua an overseas entity only. Of course, the better view was always that share or interest possibly both could apply in the context of a company. To give a concrete example, if, for example, a non-resident shareholder holds in an overseas company shares, which he transfers, assuming the overseas company derived substantial value from India, that would be taxable under the current explanation 5 to 911. If, however, he were to hold warrants of that overseas company, or if he were to have options, maybe a call option in that overseas company, or if he were to hold convertible instruments not being shares like debentures in that overseas company, whether that would be regarded as an interest in the company and therefore divestiture of that interest would also trigger the indirect transfer taxation was the subject matter of some debate. The new bill, interestingly, specifically makes changes which look to be very consciously made, in as much as it says that if the capital asset is any share of or interest in a company or entity registered or incorporated outside India. So if, as we see, there are two commas and share of being clearly suggestive of the fact that now whether it is a share of a company or an interest in a company, both would be covered for the purposes of indirect transfer taxation under the domestic new bill. Moving on further, as we know, the current bill that has been proposed provides for a transition of various provisions in the law, with the result that there is a transition provision for carry forward losses under the current 1961 Act as we move into the new bill regime from financial year 26-27, tax year 26-27. Effectively, the losses which are alive and which are being carried forward up to financial year 25-26 could be set off against the incomes under the new regime from financial year tax year 26-27 onwards. Now, one of the provisions that we are currently dealing with is the benefit of carry forward and set off of capital losses, losses under the head capital gains. The current regime clearly provides that if there are losses from the source long-term capital gains, they can be set off only against future years long-term capital gain incomes and not against short-term capital gain incomes of future years. The principle seems to be emanating from the fact that a long-term capital gain is a source which enjoys a lot of concessional treatment under the law. For example, a 12.5% rate versus a short-term capital gain which is liable to a 39%, for example, rate of tax. The principle seems to be that if I have a loss under the head from long-term capital gains, I can only set it off against income from long-term capital gains in future years, so that the tax shelter of that loss, which was from a source bearing 12.5% tax, can only be offset against a future year's income from that same source, because that is subject to a lower 12.5% tax, and not shelter a future year's income which might be subject to maybe a 39% tax like a short-term gain. This is true under the current Income Tax Act 61, as well as for all losses that arise under the new tax bill from financial year 26-27 onwards. However, when it comes to the transition provision, that means long-term capital losses incurred up to financial year 25-26 sought to be set off against incomes of financial year 26-27 onwards under the new regime because of the transition. The language of the law, the bill, seems to indicate that it can be set off, the long-term capital loss also can be set off against future years, any capital gain, including short-term gains of financial year 26-27 onwards. This seems to us to be an unintended slip. The plain language currently is clear and would entitle a taxpayer to this benefit, which may not have been really intended. One expects that probably before the bill becomes law, it might get corrected, but otherwise, as the law or the bill currently reads, this benefit would be available. It is interesting to note that this provision, which is really 536(2)(n) of the bill, contrasts with 536(2)(m), M for mother, where for all other losses, the principle is very clear and the law reads, the bill reads rather, that this carry forward will only happen in the manner prescribed in the respective section of the repealed 1961 Act. That expression, however, is missing in respect of carry forward of capital losses. Moving on further, currently, Section 79 of the 1961 Act provides, as we all know, that if the shareholding of a company in which public are not substantially interested changes by more than 49%, then the benefit of carry forward and set off may be lost, may be forfeited, because the shareholding has changed beyond 49%. That is the current provision of the domestic 1961 Act. However, when it describes this particular condition, it talks very peculiarly of something by the way of that if the shares of the company carrying 51% or more of the voting rights are beneficially held by the same shareholders, only then the benefit of carry forward continues, otherwise it lapses. So the language is shares of the company carrying more than 51% of the voting rights are beneficially held. The term beneficially held has resulted in a lot of controversy as to what happens in a case where the legal owner changes, but the beneficiary remains the same, or where the beneficiary changes and the legal owner remains the same, and so on and so forth. Because the term beneficially suggests what is important to look at is the beneficiary, but the term held suggests that what is important to look at is the registered holder of the shares. So there is a controversy as to how does one interpret this in the current context of Section 79. The new bill, which is indeed intended, one of the objectives, as was mentioned earlier, was to bring greater clarity, certainty, remove ambiguities, remove litigation, and so on, clearly provides for the concept of a beneficial owner rather than the concept of beneficially held. As we know, beneficial owner can be relevant in various situations where a person holds shares as an agent, nominee, executor, trustee, and so on, as a fiduciary. Then it is not regarded that the legal holder, registered holder of the shares may not be regarded as the beneficial owner. So what is important now is, so long as the beneficial owner of the shares is the same, irrespective of who the legal owner is, the registered shareholder is, does not matter. So long as the beneficial owner is the same, in the year in which, on the last date of the previous year in which the loss was incurred, and the last date of the tax year in which the set off is claimed, then we are good to get the benefit of carry forward and set off. If the beneficial owner is the same, who the legal owner is, who the registered holder is, will now become immaterial under the new law. So whether the legal owner is the same or the legal owner has changed, maybe the trustee has changed, or where the nominee or trustee has handed over the shares to the beneficial owner, in all cases, so long as the beneficial owner continues, the benefit of carry forward and set off of the losses would continue. One of the most respected senior counsels under the current law had opined that if, for example, a trustee hands over shares to the beneficiary, then 79 current law may actually be flouted and the benefit of carry forward may be lost. Once the new bill comes through, then this particular problem should get eliminated. Certainly a welcome move. Handing over back to you, Sameer.
No, thanks,
Thank you
Pranav.
so much.
It's good to hear about positive things as we go through this. But just one other thing, Pranav, which we spoke about, which we were debating, was around that the bill is not very clear on, some of the items like redemption of preference shares, capital reduction, etc. So do you expect, representations on that, and would that be helpful?
Sorry, I was on mute. Sorry. Absolutely, Sameer. I think these are some of the things, given the government's avowed objectives of trying to bring about greater clarity, certainty, and reduce potential situations which could lead to litigation. I would think certainly some of these aspects would get represented before the Standing Parliamentary Committee, and I'm sure the government would look at them favorably while enacting the bill. Thank you.
Thank you. Thanks for that. Let's move on to the next part and let's bring in Vijay. I think Vijay, you're going next.
Yes. Thanks, Sameer. Yeah, so in the same tone, I think more clarity, more provisions which will reduce the amount of litigation on transfer pricing. So there are a couple of changes here which are quite material. The first one is in the context of the definition of associate enterprises. We had some confusion in the past with regard to the way the section was drafted. So 92A1 and A2. The old format was that in 92A1, there was a generic clause that any participation in management, control, or capital, it led to a relationship of an associate enterprise. And then we had the para 2, which would start with the sentence for the purpose of subsection 1, which led to the interpretation that it is for the purpose of further explaining what is in subsection 1. So while there is a generic requirement for fulfilling the condition of participation, management, control, and capital, the further A2 will spell out in more detail as to what this meant. So it was kind of a subset to A1. And this led to a lot of discussions and controversy, and the matters reached up to the High Court. And Page Industries is one of the lead cases there, which is quoted quite often, where the High Court held that therefore you had to meet conditions of both A1 and A2 for a transaction, for a person to be treated as an associate enterprise. So you had to meet the threshold of participation, management, control, and capital, and meet the threshold in A2. And which meant that just because you met a condition in A2, where we had a lot of commercial transactions, for instance, dependence on an IP, or for instance, a customer who is your largest customer, all of this were deemed to be associate enterprises. But the court said that you have to first meet the condition of there being a control. And only if there is control, then the next condition is evaluated as to whether you fit into the 90% raw material supplier or wholly dependent on the IP. This has now changed, and to avoid the litigation and controversy, this has now been clarified that now you would read these two sections independently, and the way the second section in this, which is now 162.2, it now starts by saying without affecting the generality of the provisions of subsection 1, which is 162(1). The contents are the same, but now by bringing in the phrase without affecting the generality of the provision, it largely means that A1 and A2 are independent, and therefore even if you fall within the clauses which were in the erstwhile A2, which is now part of 162(2), you would become an associate enterprise, and you don't need to actually prove that there is a control also involved here. So this is tilted slightly towards the revenue to kind of support their position that they have been having. And this was a contentious issue, but at least now this puts the point to rest that you look at the generic provision and then you look at the specific, and both can be seen independently. There were certain cases where parties had commercial contracts where there was dependency on certain other parties, but the claim was that they are not related parties. But now it will be clear that if you fall within the ambit of whatever is covered as a threshold under 162(2), you would be deemed to be an associate enterprise. So that's a change. It is clear and will reduce the amount of litigation on this account. Just wanted to make a mention on the specific domestic transaction. We have a large number of sections where we have differential tax rates. We have a prevailing tax rate of 15%, 22%, in some cases 30%. And so therefore, we have now provisions which have all been brought together under the whole definition of transfer pricing to say that wherever there are differential tax rates under various sections, each of those transactions will come within the ambit of transfer pricing, and therefore there has to be a determination of arm's length price. So wherever there's a tax arbitrage which is possible because of tax rates, this will come under the domain of specified domestic transaction. In that drafting, maybe they will correct it, but sometimes when you have a transaction between a company at 22% tax rate and a company at a 15% tax rate, and the one which is at 22% tax rate is transacting with the company with 15, whether you necessarily have to have applicability of domestic transaction transfer pricing or not may need to be seen, but this is something that you need to look at as the final bill will get passed. Moving on, the next change, which is a very welcome change, and it was a very contentious issue. This is in the context of where we have a single comparable. So we know that there are various methods that are used in transfer pricing, and using these methods, you find a comparable uncontrolled price. If you find one uncontrolled price, which is one comparable, the erstwhile law wasn't very clear on the applicability of the tolerance range of plus minus 3%. And therefore, this was contentious. And this was interpreted in various ways. Like, for instance, if I pick up one comparable from a public domain information and say that this is the average price of a particular commodity on a particular date, then you would not get a range around it as per certain interpretation. And this was a contentious issue whether the range should be allowed or not. Now they have clarified very clearly that this is the way they have drafted it. Even if there is one comparable, you will get the tolerance range of plus minus 3%. And for all other situations where you have more than one comparable, there will be for a specific notification in the rules, which is in line with what it currently is, which means there's no change with regard to a situation where we have more than one comparable. But for one comparable, now the range is clear. So companies dealing in commodities, companies dealing with an internal TNMM or internal comparable single transaction have had a challenge of dealing with this. And now the plus minus 3% becomes a welcome change and more clear. And therefore, it will help taxpayers immensely with this change. Sameer, over to you.
So on this, Vijay, the last point that you picked up, given that the ALP open to be prescribed separately when more than one price is determined. So what changes can one anticipate to come in the income tax rules?
So it's not very clear, but we have generally not been very happy with the arithmetic mean and the range around that, because that is not very good from a statistical point of view. I'm not sure whether they'll make that departure or not,
but I would presume that they will stick to the 35-65 range where there are more than 6 comparables, which has been quite a healthy range, and that change was made recently and that was in the favor of the taxpayer. So probably that will stick. If the arm's length price using arithmetic mean is something that is reconsidered, maybe that may be a good idea.
Okay. All right, so let's see what comes out over there. Let's move to Sonu now to cover some of the aspects on the personal tax side.
Sameer. And as my colleagues have pointed out, I think simplification has been the mantra in drafting the income tax bill. And particularly so when you come to provisions relating to salary and house property, the finance minister and the FAQs have specifically said that these provisions have been crafted to ensure ease of compliance and make it so easy that people can just read the chapter and prepare their own tax returns. So that's been there, but nonetheless, there are a few things probably we can point out and talk about. Maybe the good fact, because of structural simplification, that we need to point out is, the income tax and rates and rebates, there's been no change at all. They've all been retained. The proposed new tax rates in the budget 2025 have also been incorporated in the new income tax bill. So that's all, no surprises there. It continues to be like that. When it comes to exemptions and deductions for total income of individuals, again, as I said, from the perspective of keeping it simple and structurally easy to navigate the income tax law, what the bill proposes is to put all of these Section 80C exemptions, these are the deductions that are available under 80C, such as contribution towards EPF, contribution towards Provident Fund, Public Provident Fund, tuition fees, the contribution made into a tax saver fixed deposit, repayment of housing loan, all of these deductions, which are eligible deductions under Section 80C, within the overall limit of 150,000 rupees under the old tax regime, mind you. These are all now in Schedule 15, and within the overall cap of 150,000 as is. So that's the structural simplification that has been alluded to many times. Now, just want to talk about a few things from a residential status. Now, we read a lot about whether there is any change in residency rules, etc. So maybe I can allay all concerns. There is no change in the residency rules per se. In fact, the provisions related to residential status have been reorganized. All of the explanations and provisos have been put in subsection and clauses, so better organized. And there is no change for Indian nationals or foreign nationals in terms of determination of the residential status. Now, there's one change, though. Having said there is no change, but there's one change that I do want to talk about. We under the existing provision, we have a provision which allows Indian citizens who are leaving for India for employment to get an extension of from 60 days to 182 days, with the phrase where if you're leaving India for the purposes of employment outside India. In fact, if I were to tell you, the current provision actually says that if you're a citizen of India who is leaving India for the purposes of employment outside India, now that phrase, purposes of employment outside India, has actually been replaced with for employment outside India. And it may not be something to be alarmed about. It could be a simple change intended to simplify the language and make it easy to read. So this really shouldn't change our existing understanding of the provision. But I do have some reservations here. Maybe I can quickly flag it. The first one is that the wider phrase that exists in the law today, which is the purposes of employment outside India, it actually supports any kind of movement under secondment or short-term assignments when an Indian citizen leaves under a secondment or a short-term assignment for a place outside India. The 60 days is easily extended to 182 days and the person becomes a non-resident for tax purposes in India. So that interpretation has been widely accepted, and so I'm wondering whether this phrase change will have any impact on that. The other one, which is more interesting, because when you talk about for the purposes of employment outside India, we have had a court, Kerala High Court actually interpret this in case of CID versus Abdul Razak, where basis the memorandum that explaining the provisions of Finance Bill 1982, when this phrase was introduced, and the CBDT circular, I think circular number 346, which actually said, and I want to be able to quote from it, what it said was that what is clear from the above is that no technical meaning is intended for the word of employment. In fact, It said that when for the purpose of employment only means that the visit and stay abroad should not be for other purposes, such as a tourist or for medical treatment or for studies or like. Going abroad for the purpose of employment therefore means going abroad to take up employment or any avocation as referred to in the circular, which basically meant that you could go and set up your own business there. You could still be considered in the wider phrase for the purposes of employment outside India. And therefore, the only concern is that it could lead to a debate whether the existing interpretation of the term will change because the words for the purposes have been dropped. But again, as the finance minister has said multiple times, and it's also brought out in the FAQs, which were issued in order to explain the income tax bill, that the language has been simplified for greater clarity and ease of compliance. So this could be maybe nothing, but I just thought I'd want to talk about this. Then another aspect is, from a perspective of income from house property. So currently, if any property is let out but was vacant for whole or part of the year and due to any reason the property was vacant, the actual rent received or receivable is lower than the market rent, then the taxable value of the house property is the actual rent received or receivable for the period for which the property is let out. In other words, you are able to get a vacancy loss for the period the property was vacant. So if the property is vacant for the entire year, you could actually say that the annual value of the property is nil because I could not let it out during the year. Now, the existing provision is saying where the property or any part of the property is let and was vacant during the whole or any part of the previous year. This is being changed in the new income tax bill, and it says in case the property or any part of it is let in normal course and was vacant for the whole or any part of the tax year. I want to be able to emphasize that there is an introduction of a phrase in normal course. Now, what could this normal course mean? Well, does this mean that the taxpayer can be asked to give bona fide evidence that the property is let out normally? And in this context, I can't help but think of an interesting decision or an interesting litigation in case of Sachin Tendulkar versus DCIT, where Mumbai ITAT finally ruled in favor of the assessee. But the challenge that the assessing officer and the Commissioner of Appeals went on to give to the assessee was that you should have documented that you made effort to let out the property. They said you should have maintained document of dispatching notices or letters to the builder. You should have made efforts to contact other builders. Now it went into a lot of detail. So I could actually think that there is a positive spin by introduction of normal costs in the phrase. That means that the assessing officer will not insist on such detailed evidence being brought to, in case this is audited and why vacancy allowance is being claimed. So it should make it easier. But, given any introduction of any new phrases can always lead to multiple interpretations. And I hope that the intent of the law and where, the government, CBDT have all gone to many lengths to say that the idea is to ease the burden of compliance. So therefore, I would like to take a positive spin to it and think that, and particularly when it comes to salary and house property, they've said that there is no intention to change the meaning of any definition or any phrase. And there are minimal changes. It's all the changes only which will help, compliance and make it easier to comply are the changes being brought out. So this maybe in itself is nothing, but I thought it's worth pointing out that this is a change that is coming in. Then again, a structural change where maybe because they want to be able to, go with the fact that all the deductions and exemptions should be easily available in one chapter, make the salary chapter easier to navigate and read. We've seen that gratuity, retrenchment compensation, voluntary retirement, leave encashment have all been moved into under section 19, which is part of the salary chapter as a deduction. Well, the death gratuity, etc., continue to be under exempt incomes under section 10. So an exemption from house rent allowance, etc., per diems are in a separate section, which is for incomes that are not taxable. So that continues. Again, another interesting, and it could be simply because they've been cutting words to make the income tax bill or the eventual law shorter in terms of number of words, etc. So currently we have a provision which says that, use of any vehicle provided by a company or an employer for journey by the SSC between office and work, office and home is shall not be regarded as a benefit or amenity. This has been changed to, just to say that any expenditure incurred by the employer for the use of any vehicle. So the change is from use of any vehicle provided by a company or an employee in the existing law to simply use of any vehicle for journey. So any expense or reimbursement related to that will not be considered as taxable. Now, does that make it more flexible or it just makes it easier? So this could be also a positive one, that it clears all ambiguity where employees reimbursing expenses of commute between office and home, that will not be liable to tax. Of course, it has to be expenditure incurred and therefore documentation to that extent is needed. Moving on to reimbursement by employer for medical treatment of prescribed diseases. So presently under section 17(2) and the supporting rule, 3A, reimbursement that's made by the employer for expenses which is related to treatment of employees or any of his family members for prescribed diseases such as cancer, tuberculosis, etc., is not liable to tax, but the employee needs to provide a certificate from the hospital specifying the disease and also give a receipt for the amount paid to the hospital. From a compliance standpoint, it's made it easier. There is no requirement now to offer that receipt or payment or certificate per se. So, Sameer, these are some of the things from a personal tax standpoint I thought would merit, mention here.
Oh, sure. So there are some questions, but I think due to, running out of time here, so we'll pick it up separately offline. But let's do the last part quickly. Ravikant, if you can just come in on the overall compliance framework.
Yeah, thank you, Sameer. I know we are very conscious. We are on the top of the hour. I'll be a little fast to complete. First is about reassessment related provisions. Presently, the phrase is in information available with the assessing officer to permit the AO to reopen the assessment. There are certain items provided. Now what is being amended is that if there is a directions of the GAR approving panel, then that can also constitute an information available with the assessing officer and by which he can initiate the reassessment. In this particular case, he will not be required to do that 148A procedure of giving notice or giving pre-notice inquiry. The second part is that presently the law enables the AO to reassess the case wherever there is a finding direction by the authority, tribunal, court, etc. Now it is clarified that he did not follow the 148A procedure of making the inquiry before he issues the final notice for filing return for the reassessment. The third item is there was a provision under the old reassessment regime before 2021 that if the reassessment is the case is reopened, but the SSC is able to show that the income has not escaped assessment because of some other factor, for example, some other deduction was not granted in the original assessment and which is legally entitled to it, and that is not a subject matter of any appeal, etc., then the assessing officer had the power to drop the reassessment proceedings. That was not there in the new regime which came in from 2021. Now, it's a very positive feature. They are reinstating it, which will help the assessees in cases where they are able to show that effectively no income has escaped assessment and therefore the reassessment proceedings can be dropped. The next is about the DRP. Now, what is mentioned, what is called out, of course, it is implicit, but what is now codified is that when the DRP gives the final order or directions, etc., gives its decision, it has to specify the reasons also. So it will make them more accountable and it will help the future litigation. What were the basis for the directions? The third is about the scope of the powers of the tax authorities in case of search. Now, the tax authorities in respect of search and seizure under the current Income Tax Act have the power in certain situations to require the persons in possession or control to afford the facility to inspect books of account or which are maintained in physical form or in electronic record. And electronic record, the definition goes to the Information Technology Act. The new bill seeks to go further. And not only it moves away from the definition of computer systems as per Information Technology Act, it defines it in the Income Tax Act, New Income Tax Act itself in a comprehensive manner. And it also confers a powers to the tax authorities to enter and search the premises where any information is stored on computer systems inspect them, gain access to such computer systems if required by overriding the access codes, etc., make copies, etc. And also this definition of computer system is also expanded to include virtual digital space, which in turn is also very widely defined to include email servers, social media accounts, remote cloud servers, etc. We go to the next slide. Now, in case of updated return of income, it seems there has been an anomaly. Under the present law, when you are filing an updated return for a particular year, and because of you are offering additional income for that year, if the subsequent years carry forward, etc., is impacted, then you need to file an updated return for the subsequent years also. There is an obligation on the taxpayer. That provision is missing in the new bill, which we feel is a drafting anomaly, and it may get rectified as the law is enacted. The next important thing is about this lower TDS certificates and the nil TDS certificates. Under the current law, there is a provision both for residents and non-residents to approach the AO and take a lower or a nil TDS certificate. Now what is provided is but this the provision is sort of restrictive for residents. It does not cover all the TDS provisions. So for example, 194R business perquisites, etc., it is not covered. Now the facility is made available that in case of any TDS falling under any provision, the resident can go and approach and take a lower TDS certificate. Unfortunately, on the flip side, the facility for obtaining nil TDS certificate is conspicuously missing. In fact, in case of non-residents, under 195.3, the non-resident payee can go and take which are the branches of the foreign companies operating in India, and prominently the foreign banks who are operating in India. They take an annual nil TDS certificate based on which their customers need not deduct the tax. Unfortunately, that particular provision is missing in the new bill. We will need to find out it will, if it is finally enacted in this same manner, it may create a lot of practical challenges. We may need to find out what is the rationale, and hopefully it should get rectified as the bill is enacted. And finally, there is a provision popularly called 281, where if there are any assessment proceedings pending in case of a taxpayer and he tries to transfer any of his assets, then the transfer can be regarded as void unless there is a carve out that if the buyer had purchased that asset in a bona fide transaction without knowledge of the pending proceedings, or they had taken an NOC from the AO, then this provision will not apply. Today that asset is defined to cover many assets, land, building, share, securities, etc. Now one more asset is added, which is the virtual digital asset. But what we believe the transactions which are happening on the crypto exchanges may not get impacted because there the transactions happen in that system through the system, and the buyer does not recognize the seller. So therefore, in that case, most of the transactions will fall under the carve out for a bona fide transaction. I think that's all from my side on the compliance side. Back to you, Sameer.
Thank you, Ravikant. I think that was very comprehensive. So as I had mentioned earlier, the parliamentary committee is to take up the bill, and they are required to submit the report as indicated on the first day of the next session. We believe what that means is that this will be the first day of the monsoon session. So effectively, this will be somewhere based on how the monsoon sessions are typically in the past years, somewhere in the second half of July. So we do have time till then, and of course the parliamentary committee is expected to interact and to consult, and therefore as industry and as practitioners we ought to do our part in bringing out these points that were raised, and I'm sure there will be others because this was done at a very short turnaround of about 24 hours. So friends, thank you for joining and being with us, and there are several questions that have come, and offline we will look to responding to those. So thank you very much for joining us this evening. And thank you to all my fellow panelists as well. Thank you.
Thank you. Thank you so much.